Let's look ahead to the final month of the year and beyond. Joining us now is Citigroup U.S. equity strategist ScotScottt Chronert. Has an S&P 500 year-end target of 4,600. We're pretty much there. Mid-2024 target of 5,000. So what's your feeling about all of this going into 2024? You heard our conversation.
Yeah, I think you guys are spot on, Sarah. I mean, I think we still are focused on the Fed for good reason, right, in terms of an indicator of where they're taking policy, which is still quite restrictive by their definition, for what it's worth. But, you know, our focus has been on 10-year nominals for some time now, and that move towards 5% from the July timeframe when we were 4% really did add a number of areas of angst to investor confidence and psyche regarding the outlook. And so with the rate rally, you know, since mid-October, you really have had a release valve at work in the markets that has benefited everything from tech, but also those areas of the market that were most concerning relative to a higher for longer rate regime, such as real estate, which has led over the past month or so. So the point here is that the broadening effect on the back of interest rate relief cannot be ignored. It's something that we've been talking about and have been playing to relative to our earnings outlook for next year, and we still think it's very much in place.
So here's one question, just how big the November rally is. You can't really point to technical factors like sentiment anymore. I mean, the AAII investor survey shows that they're the fewest bears, I think, back to 2018 right now. And some of the seasonal factors, all the favorable positioning stuff that people said would lead to a year-end rally. Have we done all that in November just because it was so big? Is that a headwind now?
I think, you know, look, anytime you put a 10% move on the S&P, you have to allow for it to digest that move. That, to your point, is a very major gain. So, you know, look, we're at 4,600 for the end of the year. We feel pretty comfortable that we'll muddle through this next month. Obviously, we're going to be laser focused on incremental macro data points that are going to confirm or not this deceleration in inflation. We're going to keep an eye on 10-year nominals. You don't want to see them backing up from here. That would be a short-term cause for concern. But look at our playbook going into 24 is unchanged. That 5,000 mid-year target since the July timeframe has been premised on a broadening from an earnings growth perspective, and we still think that's very much in play going into next year. So, you know, again, color us bullish in terms of the S&P earnings outlook headed into 2024.
Do you not worry, though, at all about margin pressure in a disinflationary environment? I'm just thinking about Kroger yesterday. You know, when prices were high, these companies did well from a profitability standpoint. And so I know it's good for the market if inflation comes down, but is it really good for corporate earnings?
Yeah, so it's going to be a really mixed bag. I mean, we've been talking about margin pressure concerns for the second half of 23 since last February, actually. And so we know it's out there. We know it's out there as an issue. We know that higher inflation had buoyed revenues. You know, we like to remind that the S&P 500 earnings picture is really interesting. It is not as correlated to GDP trends as you would think, okay, real GDP trends. However, nominal GDP has a very high correlation to S&P 500 sales. So the point here is that we have to allow for this inflation deceleration dynamic to play out a couple of ways. Yes, you're going to see pressure on pricing. That's to be expected as you run through this normalization on the heels of the post-pandemic rally and supply chain constraints. But we also have to allow that you're going to see some relief on input costs. So the picture going into 24, I think it's going to become a little bit more company and probably sector specific in terms of this margin pressure concern. It's certainly an issue, but one that we're not seeing any real signs here that it's going to really impact our full year earnings growth objectives for the S&P.